you coming here on a weekly basis and supporting Cash Flow Champs, and also hopefully learning something along the way. We want to be a resource for you in the multifamily real estate space. So we appreciate the support, and glad to share the knowledge. Today we'll be covering the topic equity structures, equity waterfall structures for apartment syndication. So in this webinar, we will touch on what is equity waterfall, right? We'll talk about a little bit hurdles, capital stack, and the waterfalls, and then the three most common type of equity waterfall structure. So we're going to touch on those. But first, for those who don't know me, and even for those who do, let me just introduce myself. I am Paul Sr., one of the managing partners here at Cash Flow Champs, and I live in Maryland, right outside Washington, D.C., with my wife and 3 children. And to get more information on us, you can simply go to our website, cashflowchamps.com. If you hover over the About button, then you can click on each of the managing partners there and the partners there of Cash Flow Champs. There are 6 of us who runs the Cash Flow Champs team. I am co-host with my partner, Prashant Kumar, for the Cash Flow Champs Real Estate podcast. We normally have a session come out every week, so feel free to get some information there as well. We tend to have good guests there on the show as well. Our portfolio to date is a little over $70 million at this point. We just closed on a deal last week, 2 weeks ago rather, and so our numbers have increased there. So we're thankful for those of you who supported us, and for those who haven't, we do have opportunities coming up, and do have opportunities now that you guys can also partake of. We offer some free resources for you that you can take advantage of in addition to this webinar here. On Saturdays, Charles Seaman, one of our managing partners, does the underwriting session at 4 o'clock, so you can tune into that. And we also have a paid program, which is the Aristocrat Coaching Program. I would really strongly advise for you guys to check that out. So if you look at the screen on the far right, that is, and you can just scan that QR code. You should be able to get some more information on that, and you can support that. We're teaching folks how to invest in multifamily real estate. Whether you're just starting out, you can join us for sure, or if you already have a few hundred units on your belt and just want to scale that some more, that we can also help you to do that as well. In November, we'll be having our Cash Flow Champs Virtual Summit, and we'd appreciate if you guys can sign up for that. That is something that we want to kind of make available to you, another free resource that we have for you as well. I want to just speak a little bit today about the deals that we have. We have 2 deals currently. To join our passive investment club, you can always come to our website here at cashflowchamps.com, and you can just click on that, and you can simply go in there and you can just fill the information out. We can schedule a call with us. There's some basic information that you can fill out there, and somebody from the team, maybe myself, being on the investor relations team, will definitely get in touch with you and answer any questions. We have 2 deals right now, so if you go to our click on our investor portal, then you can also go there as well, and you can kind of see the deals that we have. You can click on those. Both deals are open for investment. We did close on the Park Valley apartment home deals, but we do have a few more slots that's available there that we can get you in on. So those are just some of the things that we want to share with you here regarding the free resources. As a means of disclaimer, I want to let you know that I am not a financial advisor and an attorney. The information we provide here is strictly for information purposes only. So we ask that you contact the appropriate personnel when you're going to use this information, okay? So let's just jump into the topic for today. Going to be a good topic. Trying to get out of here by 11:30, so we won't hold you guys long. So definitely, if you have any questions as you go through, feel free to put those inside the chat, and we will definitely answer them as we go. And also, we may get to them at the end in case we don't get to them as we go throughout it. So the first obvious question is, what is equity waterfall, right? So when I think of waterfall, I normally think of it in terms of just water flowing from one bucket to the next, right? As each bucket gets filled up, then it kind of flows over into the other bucket, and it continues just like that. So equity waterfall is a term used for the way partners distribute the shares of the profit in an investment. So in apartment syndications, a waterfall describes how the profit or the proceeds are paid in the apartment syndication deal. It describes when it is paid in the apartment syndication deal, and it also describes to whom it is paid in the deal, right? So the type of waterfall will determine the returns to the limited partner and also to the general partner. So there are different types of waterfalls. Of course, we're going to touch on those today, but ultimately the general partnership decide which waterfall structure to have in place for the deal that you're going to participate in. So equity waterfall is common in all types of private equity investments and is especially prevalent in the real estate private equity industry. So on the screen, you will see now there's a waterfall structure of a waterfall payment. A screen, you'll see the depiction of a waterfall payment structure here. So for the waterfall payment structure, it requires that the higher tier creditors get interest and principal payment first in full, and then the lower tier creditors will get their payments next, right? So in the waterfall payment structure, you pay from the top down. So when you get proceeds from a sale, for example, if you get proceeds from a sale, you will first pay the debt to the lender, right? So think of this as monies that is flowing into this bucket, right? You just had a sale, you have monies from that proceed sale flowing into this bucket here. So the first thing you're going to pay is fill this bucket up. You're paying the debt back in the waterfall payment structure. Once you pay the debt back, which is your senior lender, then you'll have it flows, the rest of the proceeds from the sale flows over into the next bucket, which is your pref equity bucket. If you have a pref equity piece in there, right? This middle piece doesn't necessarily have to be there, but if your deal is so structured that it has a pref equity piece, then that would be the second in line in terms of getting payment. So once that is filled up right here in terms of the cash flow from the sale of the deal, then you will have it flows over next into the common equity, right? So you can see it continues in that pattern. So this is the waterfall payment is directly opposite to a capital stack. So one of the things that we'll touch on is the hurdles, the capital stack, and the waterfall as well. So this is what the capital stack look like. We've done a session on the capital stack before, so we won't stay on this too long, but I just want to draw the comparison between the waterfall structure there and the capital stack there. Waterfall payment is directly in opposite, or it's really is the inverse really of the capital stack. So in the capital stack, you build from the bottom up. Just now we described the waterfall, of course, flowing from the top down. So in the capital stack, just like a Lego, whatever set, you're going to build from the bottom up. So you start with your debt at the bottom of the capital stack. So that would be your senior debt here. So in terms of the priority of payments, you start at the bottom with your debt. And then you go to your pref equity, then you go to your common equity, and finally, you go to your GP equity, right? So you can see that the arrow for the priority is pointing down, which means that the further down you go in the capital stack, then the higher priority in terms of payments. On the other hand, the level of risk increases as you move up the capital stack. So here where the risk is, as you move from the senior debt up to the GP equity, then the risk increases. So it puts the GP equity really at the position of the highest risk. They are the last to get paid their return in the deal after everybody else. So the GP normally, put a lot of sweat equity into these deals. The GP is not necessarily putting money into the GP shares. So in a way, it can provide infinite return. One thing you also got to know is that the risk and the reward is a playoff here. So the higher the risk, normally the higher the reward in these type of deals, right? So in our current market, for example, the senior debt is commanding what you can say between 5 and 6% in terms of, in terms of returns, the kind of interest that you're paying on your type of debt these days, right? So your pref equity is normally higher than that, right? So if your debt, which is the least risky, is commanding 5-6%, your pref equity may be between 10 and 12% in the current market, maybe a little bit higher, right? But you can see that it increases because the risk increases above the senior debt as it pertains to the pref equity. And the common equity is even at a higher risk than both of those. And so you're probably, I would say, 12% or more that you'll probably be paying in terms of your common equity. So the senior debt and the pref equity will not normally participate in the upside of the deal, but the common equity will, right? So that also speaks to the risk and reward in terms of these type of a situation. But as a GP, even though you don't put money necessarily in the GP equity, as a GP, it's good for you to invest alongside your LPs, right? And so it is good to put some money into the deal. And normally we do that in terms of putting in at the common equity level, right? So the cash flow champs, we tend to invest up to 10% of the equity in the deal. And we do this by purchasing the common equity shares. So this often shows up, it really shows the LP that, we're confident in the deal and that we're also willing to ride the deal with them all the way to the end. Because really, GP co-investment may be really the best indication of alignment of interest in any type of a deal. So that kind of highlights the main difference there between the waterfall and the capital stack. And so we just want to make sure that there was clarity there between that, because sometimes this can get a little bit confusing. So I hope that provides some type of clarity here. So now let's take a little bit deeper dive into the equity waterfall structure. So there are normally 3 types of equity waterfall structures, right? We have the cash flow waterfall, we have the refinance waterfall, and we have the sales promote waterfall. And so what you are seeing on your screen here is just an example of the cash flow waterfall. So the cash flow waterfall structure is the most basic and probably the most common equity waterfall structure that you will see. So these are single tier waterfall structures. They do not have a pref piece to them, so they're just one class of shares, right? So we do not have an A class and a B class share here, just common equity shares. So with the cash flow waterfall, it has to do with how you handle the cash flow generated from the property during the whole period. The refinance waterfall more has to do with, both the refinance waterfall and the sale waterfall has to do with how cash flow is handled when there's of course a refinance in a refinance case, or maybe if you have a supplemental loan in the case of agency debt, then the refinance waterfall will handle that. The sales waterfall will handle the cash flow at sale. So how is the proceeds from the sale distributed? That is how the sales waterfall will take care of that question, right? So with the cash flow waterfall, the cash flow is generated from the deal. So the cash flow generated from the deal is first used to pay the preferred return. So if you look on this here, so in this case, there's a 7% preferred return that the LP is promised to get. Now, this preferred return can vary, just depend on the operator or the syndicator that you're dealing with. That normally range anywhere between, I would say, between 6 and 10%. But in this case, we have a 7%. So in this example, the LP put 100% of the equity and they receive 7% return for their investment. So during the whole period of the deal, the cash flow will be generated, right? So as cash flow comes in, what happens is that it starts to fill up this bucket right here, right? So it's the cash flow that is coming in from the deal fills up this bucket until that 7% return is met. So once that 7% return is met, then the cash flow obviously flows over into this next bucket down here, right? And it flows into this next bucket below of it. And of course, once that bucket fills up, then it also flows into the next bucket below that as well. So each time it flows from one bucket to the next, it meets a hurdle, right? So in this case, there's a 7% preferred return that is given when that hurdle is met. So between 0 and 7%, the cash flow that comes in goes in and fill that bucket up. Once that 7% is met, it meets a hurdle here and it goes down to the next where there's now a 70-30 split. So at first, the GP was not getting anything of the cash flow until that 7% return is met, right? But once that 7% return is met for the limited partners, the LPs for limited partners, GPs for general partners, once that 7% is met, then any cash flow above that 7% is now split 70-30 between the LP and the GP, right? And a hurdle, that's probably a new term for some people. The hurdle is just simply a performance-based metric that allow the GP to partake in a portion of the cash flow, right? So in this case, once the 7% is met for that, then any cash flow above that goes 70-30. And once that is met also, once another metric is met, then it also can be split 50-50 between the LP and the GP, right? So in so once you hit that performance target, then the split changes and the GP gets a bigger portion of the cash flow above the preferred return, right? So of course, that's an incentive for the GP to continue to outperform projection and to make the deal work as best as possible. Normally, you will have like an IRR hurdle here. So you may have, but I don't know, maybe a 13, and normally between a 13 and a 15% hurdle here that you meet in terms of getting between the 70-30 split to the 50-50 split. So once you hit like say a 15% hurdle, then the split take place where the GP get a bigger portion of the cash flow that is in the deal. So that's your cash flow waterfall. This more depicts what we call the refinance waterfall or the sales promote waterfall. They're very similar to each other. So both are a single tier waterfall structure. And so we kind of have it here looking very similar. This is referencing the waterfall structure when there's a capital event, right? So in this case, if you have a refinance of the property, then this handles what happens to the proceeds of the sale. So first and foremost, we have to know that before all this takes place, your debt gets paid, right? So your debt has to be paid first. That was first priority in line. So this is after your debt gets paid. So the debt gets paid first, and then whatever cash flow then flows through the model that we're looking at right here. So if there's any unpaid preferred return that didn't take place in a year or two prior, whatever years, then you know that at this event, the sale of the event, then that has to be accounted for at first, right? So in this case right here, it's important to know whether or not you are dealing with a model that has a cumulative return or a non-cumulative return, right? So in cumulative returns, what happened is that if your projected preferred return is not met, like the 7% we're talking about, if that's not met, then it is carried over to the next year. And then it keeps carrying over year after year until the sale. And then, of course, it is accounted for at sale. And so the limited partners or whomever the investor is will get paid at the sale from those proceeds. In deals where they're non-cumulative return, then that pretty much goes away, right? So it's important for you to know what type of deal that you're working with, so that you can, you can know what happens if your preferred return is not met along the way. Here we have the debt already paid for, and then your cash flow comes in here, right? Again, if the preferred return is met, and if it was accumulated and cumulative, then it brings over here, and whatever that total amount is, that is taken care of first and foremost, your preferred return, right? What happens after that is that cash flows go down next onto your initial investment. So some people may invest 100,000, some may invest 50,000, whatever that is, then that is taken care of in terms of the cash flow from the deal. So the debt is paid, then you have that cash flow come in. It takes care of the preferred return here. From the preferred return is taken care of an address, including any cumulative preferred return. Then the funds that's left over also pays for the initial investment that the investor invested there, right? And from there, once that is satisfied, meaning that everybody's initial investment is returned, then you have the split taking place, right? So above the 7% preferred return, then there's going to be a 70-30 split, right? And that is 70% to the LP and 30% to the GP. And then we're going to have another performance hurdle. At this space, normally it's probably about, I don't know, you can be anywhere from say 13 to maybe 16% in terms of your IRR. If you have but that's written in your documents, right? So either your PPM should have that information, or your operating agreement should let you know what those performance hurdles are. So if in the case where this is a 15% performance hurdle, if you fulfill the 70-30 split and there is still cash flow left over, then that will go into the 50-50 split. And this 50-50 does give a bigger portion of the proceeds that's left over to the operators. And then that way it finishes out all the cash flow that is in for that deal. So that is a very good example in terms of how it flows, from the sale to paying for the preferred return, then paying for any initial investment of capital, then the split 70-30. And if the operators hit the deal out of the park, meaning they did a good job where there's enough proceeds to go beyond the 70-30 split, then they're rewarded for that in terms of a 50-50 split with the IRR hurdle that was specified before. So those are really the different equity waterfall structure and hurdles. We talk about the cash flow waterfall, which is the very most basic one. And the cash flow waterfall, it does not necessarily, have to have the third level at all times. Some folks just go with level 1 and level 2, and they just ride it that way for the whole deal. But of course, some operators do put another hurdle there, where if they meet like a 15 or 16% IRR hurdle, then they get compensated even more for that. So you want to kind of really see what type of structure that you're dealing with. So that's a pretty good outlay here in terms of, you can see the similarities between the refinance waterfall and the sale waterfall. They're pretty much identical. Of course, middle one is just referencing refinancing taking place, or like we made mention, maybe you get a supplemental loan there as well if you're dealing with agency debt. And the sale, of course, is when you're exiting that deal and the deal is sold, and then all the proceeds is accounted for at that point in time. So let me just see if we have any questions here. That's pretty much what we have addressed here today. If you have any questions, and you can throw them into the Q&A, and we'll see if we can answer those. So one question here from Devon is how do you decide which one to use? Well, really, they're all a part of a deal, right? And so because all this will take place, maybe you don't have to do a refinance in your deal necessarily, but your first one, which is the cash flow waterfall will take place in just about every deal once you have cash flowing through the deal, right? So you may not have the refinance in a particular deal, but the sale, will be there too, unless you're going to hold that property as a legacy property and hold it forever. In that case, you'll only have the cash flow waterfall taking place, and then you can decide, whether or not you want to go from a 70-30 split to a 50-50 split. It may be that, so it depends on what you want to necessarily do with the deal, really how you decide which one you want to go with. But in essence, all three of these can really take place in any given deal. Most people don't refinance deals these days, very, very rare. Normally you have them purchasing them and then selling them. So you probably have your cash flow waterfall in the very beginning and then your sales waterfall at the end. Harnish is asking, can I give an example with real numbers? I'm not prepared for giving an example with real numbers here. This was more a general overview in terms of letting you see pictorially what it kind of looks like. I would have to, get that together in terms of getting real numbers there. That I do not have prepared to present here today, because really we're up against the time now anyways. You want to ask how you connect with me separately to learn more about that? Yes, I'll be glad to talk with you more. That you can simply send me an email, send it to Paul at cashflowchamps.com. Can put it in the chat, Paul at cashflowchamps.com, or yeah, that's probably the best way to get a hold of me. We can definitely go over something like that using numbers, and you can see how that plays out in the model. That's a great question. We got a great turnout here today. It's about 11:30 now, right about the time. So if there are any other questions, you can just drop them in the chat right now. And Rose says 100,000 should be a simple example to use real numbers. I like numbers too. Numbers I understand. Again, I can try to create something here while we're here, but for example, let me see. Somebody invests $100,000, for example, right? They probably going to get a 7% preferred return. That would be $7,000. They get it right here. So if the deal is cash flowing, say at 10%, right? So that would be $10,000 that the deal is generating. So if the deal is cash flowing at 10%, then 7% would come in here. So the investor, the LP, would get $7,000 here, right? So when that $7,000 fill this bucket up, what's left over? That would be $3,000 that's left over, right? So you've met this metric, you've met this return that's required here for the investor, and then you got $3,000 that spills over here, right? So well, let's go back to the one before that, the simpler one. So the 10,000, if you have a 7% preferred return, you invested $100,000, that was your LP investment, and the deal is cash flowing, say 10%, then $7,000 is what's going to fill up this bucket. $3,000 is going to be left over that flows down here. So that $3,000, 70% of that $3,000 is going to be for the LP. So 3,000 times 0.7, that's what's it, $2,100, right? So $2,100 would go to the LP here, and the balance, which is $900, would go to the GP here, right? So that would take care of it at that level, right? So that's where that would stop. If it is that you had more monies that left over after this bucket is satisfied, say, for example, you have, I don't know, say you have $1,000 that's left over, then that would be a 50-50 split, where 500 would go to the LP and 500 would go to the GP. So using those round numbers, that would be a general example of what the cash flow would look like for that. I hope that helped, Rose and Harish. All right, guys. So, again, we appreciate you coming on today. Any more questions, we'll entertain those. If either one of you guys want fuller understanding of it beyond that example, you can just always reach out to me. We can go to the actual model. Thank you for your time. Appreciate you coming today. And Please sign up for next week. Prashant will be presenting next week. He has a great topic for next week. So you'll see that send out to you guys by our email and our marketing guys. And please come back and support us. And we'll continue to provide information to you on a weekly basis. Thanks. Have a great day now. I have a question here from Queenie. I'm sure she's still there, but she asked, who determines the cash flow percentage? The cash flow percentage is determined by the operators. Another question by Devon is asking, is there an alternative to the waterfall method? Yeah. You don't necessarily have to do a waterfall. You can do a straight split between the GP and the LP, where they just decide up front that it's going to be a 70-30 split period throughout the whole period. Or you can just decide an 80-20 split. You can decide exactly how you want to cash the flow through the deal. Doesn't have necessarily to be a waterfall. All right. Thanks again. Appreciate your time. And we're going to sign off now.